Welcome back to the Community Corner podcast, where we explore companies in the S500 through the lens of behavioral finance. I'm Arnav.
And I'm Nikhil. Today, we're turning our attention to Nrg Energy, a leading integrated power company that provides energy generation, retail electricity, and energy services. Nrg is known for its efforts in transitioning to cleaner energy sources while maintaining a significant presence in conventional power generation. We'll explore how behavioral finance influences their strategic decisions, DEI efforts, adaptation to market changes, and how they compare to other companies in the energy sector. Let's dive in.
Nrg Energy has positioned itself as a key player in both conventional and renewable energy markets, but from a behavioral finance perspective, how do biases like status quo bias and optimism bias influence their decision-making, particularly in their energy transition strategies?
Status quo bias can play a significant role at Nrg Energy, particularly as they balance their investments in conventional power generation with their shift towards renewable energy. This bias might lead the company to favor maintaining their established conventional energy assets, even as market and regulatory pressures push towards cleaner alternatives. While this can help Nrg manage the risks associated with a rapid transition, it may also slow their progress in adopting new technologies and business models. Optimism bias is another key factor, where the company might be overly optimistic about the potential success of their renewable energy projects, potentially underestimating the challenges and risks associated with scaling these operations. This bias can drive ambitious goals, but it also requires careful risk management to ensure that these investments are sustainable.
This balancing act between maintaining conventional assets and expanding into renewables has helped Nrg Energy appeal to a wide range of investors, from those focused on stability to those interested in growth through clean energy.
Exactly. Nrg Energy's approach to balancing their conventional and renewable portfolios reflects a nuanced strategy that appeals to both conservative and growth-oriented investors. However, they need to carefully manage the risks associated with both maintaining their traditional assets and pursuing ambitious renewable energy goals.
Let's discuss diversity, equity, and inclusion at Nrg Energy. As a company operating in a rapidly changing energy sector, how does DEI intersect with their business strategy, and what insights can we draw from behavioral finance?
DEI is crucial for Nrg Energy, especially as they navigate the complexities of the energy transition and engage with diverse communities and stakeholders. From a behavioral finance perspective, embracing DEI can lead to more innovative and inclusive decision-making, which is essential in an industry that is undergoing significant transformation. A diverse workforce can help Nrg better understand the varying needs of their customer base and develop solutions that are both effective and equitable. For investors, the company's commitment to DEI can signal a forward-thinking and socially responsible organization, which is increasingly important in today's market. Additionally, strong DEI practices can improve employee satisfaction and retention, which are critical for maintaining operational excellence and driving long-term growth.
Investors are increasingly considering DEI as an important factor, especially in industries like energy, where understanding and addressing diverse customer needs and regulatory environments is key to success.
That's right. By embedding DEI into their corporate culture, Nrg Energy not only strengthens its ability to navigate the energy transition but also enhances its reputation as a leader in creating an inclusive and equitable workplace. This focus on DEI can also help the company attract top talent, which is crucial for driving innovation and staying competitive in the evolving energy landscape.
Moving on to market adaptation, Nrg Energy operates in a highly competitive and regulated industry. How does the company adapt to changing market conditions and technological advancements, and how does behavioral finance influence this strategy?
Nrg Energy's ability to adapt to changing market conditions and technological advancements is critical for maintaining its leadership position in the energy sector. From a behavioral finance perspective, the company's strategy involves balancing the need for innovation with the risks associated with transitioning from conventional to renewable energy sources. While status quo bias might make NRG cautious about rapidly divesting from traditional energy assets, they also recognize the importance of investing in clean energy technologies to stay competitive. This requires a careful assessment of market trends, regulatory pressures, and technological advancements to ensure that their energy transition strategy is both effective and sustainable.
This adaptability is key for Nrg Energy, especially as they face competition from both traditional energy companies and newer, more agile renewable energy firms. Their ability to navigate this transition is essential for their continued success.
Exactly. Nrg Energy's success will depend on their ability to balance the risks and opportunities associated with the energy transition, ensuring that they remain competitive while also maintaining the stability that their investors value. They must continue to evolve and adapt to meet the challenges and opportunities presented by technological advancements and changing consumer expectations.
Now, let's compare Nrg Energy to other companies in the energy sector like NextEra Energy, Duke Energy, and Exelon. How do Nrg behavioral finance dynamics differ?
Nrg Energy's dynamics are often compared to other energy leaders like NextEra Energy, Duke Energy, and Exelon, particularly in their approach to the energy transition, risk management, and market adaptation. Nrg emphasis on balancing conventional and renewable energy assets appeals to investors looking for exposure to both stability and growth in the energy sector. NextEra Energy, known for its aggressive investment in renewable energy, appeals to those interested in a more focused clean energy play. Duke Energy, with its diversified utility operations, offers a more stable, regulated business model, while Exelon's focus on nuclear and clean energy positions it as a leader in low-carbon energy production. Nrg focus on transitioning while maintaining conventional assets provides a unique value proposition, but it also means they must carefully manage the risks associated with navigating two different energy markets.
And unlike NextEra Energy, which has a stronger focus on renewables, Nrg Energy's strength lies in its balanced approach, allowing it to leverage existing assets while pursuing growth in the renewables sector.
Absolutely. Each of these companies has its own behavioral finance dynamics that influence how investors perceive their value. For Nrg Energy, the focus on balancing conventional and renewable energy assets provides a unique value proposition in the energy sector.
To sum up, Nrg Energy's approach to business is deeply influenced by behavioral finance principles, whether it's through their energy transition strategies, DEI initiatives, or market adaptation. But like all companies, they must navigate the biases and perceptions that can influence investor behavior.
That's right. Understanding these dynamics offers a clearer picture of what drives Nrg Energy's stock price and where the potential risks and rewards lie. And I'm Nikhil. Stay curious and keep questioning the narratives.